Hello everyone, my name is Joven Salamita and I'll be presenting on cash flow estimation from chapter 12. And the question is, how would you teach the concept of cash flow estimation in the most simple of terms to a non-financial person? Now basically, cash flow is the money that is flowing or moving in and out of a business in 1 month. Although it does seem sometimes that cash flow only goes one way out of the business, it actually flows both ways. Like for example, cash coming in from customers or clients who are buying your products or services. If customers don't pay at the time of purchase, some of the cash flow is going into collections called accounts receivable. Now, cash going out of the business for the form of payments for expenses like rent or mortgage or services rendered for your third-party vendors, their accounts payable. Now, cash flow statement gives us an idea as an indicator of the health of the business. Uh, it's like your doctor evaluating you on your health. So a cash flow is a metric or a sheet or an accounting balance sheet that gives us an idea of how stable the business is in a sense. And so there's formulas here that shows the cash flow, EBITDA, but generally it's called cash or capital budgeting, and it's the process a business undertakes to evaluate potential major projects or investments. The goal is to increase value for the business. So, for example, like Home Depot, if it decides to open up another store, it would send its engineers, its consultants, its all of its personnel to evaluate whether it's worth their cash flow to open up their business, if it'll increase the value for the business. And certain businesses, they go through an analysis whether if the risk is worth their cash. And there's some concepts that our textbook goes through to helps us analyze whether going through this steps of using our cash flow to open up another store or go through a project or invest into a certain thing that will increase value for the business. Now, the impact of cash flow is whether it's positive or negative, right? So free cash flow might be used to seize other opportunities to generate more income through acquisitions or developing innovative projects. So that's why there's opportunity costs, there's sunk costs, and certain things that a concept the book talks about. But in other words, for example, sunk costs can be described as the money that was used to go and figure out if Home Depot's personnel gave you the green light to go ahead and open up that store. Now, you can't recoup those costs that were spent to evaluate whether it was worth your money to open up that store. An opportunity cost would have been, well, we could have used that money for an acquisition of something else, innovative products or other opportunities, investment into the market, things like that. They could have used that same cash for something else, and that's opportunity cost. You had an opportunity to either open up that store or opportunity to invest in something else that may increasing value for the business. That analysis of the cash flow is what businesses do, is how you manage the cash flow. And there are three risks involved. There's standalone, corporate, and then market beta risk. In other words, not just think of it as a picture of your business checking account over time. If more money's coming in than going out, then you have a positive cash flow. And if you have more cash going out than coming in, then you have an idea where you're overdrawn and you're going to have to figure out how to pay your bills. Now, the idea is, it's not as simple as that with businesses that are more seasoned, because they have to manage their cash flow versus a startup business where cash is king. Well, cash is king in all aspects of business, but particularly a startup business, cash, for example, for some business like restaurants and some retailers, cash is really cash and currency versus like paper profits. The business takes cash from customers, and sometimes it pays their bills in cash, and has and sometimes they track it with invoices and things like that, but it's still cash. So what's the impact? Why is this so important? Like seasoned businesses, for example, cash flow is particularly important for several businesses in that it fluctuates and they have to manage it properly. And it's, in a sense, it's different than profits. Like, okay, for example, if it's possible that your business can make a profit but have no cash, and how can that happen? The short answer is that it's an accounting concept. While cash, as noted earlier, is only like a checking account. You can have assets like machinery and equipment, and you're waiting for them to actually pay out on the invoices. So it's not really cash. It's you're counted as profits, paper profits, as though you receive the cash, but you haven't really received it. It's only accounting credit. So your accounting system gives you an idea of the profitability in a sense in relation to the cash flow statement. That's why your cash flow is truly an indicator of whether the business is healthy. And if you look at the analysis of, are these things here, these risks, worth our cash flow to expand into a project or to do certain things like standalone risk, corporate within firm risk, and corporate and beta risk. Yeah, in other words, standalone risk is a good proxy for other kinds of risk, and they have three kinds of ways to analyze the three different types of standalone risk. Is sensitivity analysis, which allows organizations to determine the impact of the outcome and risk of the project or investment. There's scenario risk, best case scenario, worst case scenario risk, and a Monte Carlo simulation uses computers and software to calculate whether forecasting and it provides a different outcomes to help people understand the impact of the risk. Next is the market risk. For it's most relevant if you use market risk. It's most relevant because it changes in interest rates and inflation and stability. It goes by the market, and you can get an idea of whether it's risky to expand or open up a new project based on the market. But it can't be measured because the market is volatile and it's unpredictable. The corporate within firm risk is based on return on investment specific to a company. So if all the projects that a company operate have flexible return, then a company's firm risk is higher. So, in other words, similar to a standalone risk, it's related to a specific company. So it constitutes a project's return on investment. So it's within its best interest to do the analysis of that specific company, let's say a manufacturer or dependent on certain products that are being developed or services. Now, in conclusion, the purpose of a cash flow estimation is finding the net present value of what is the risk, and it shows by calculating that you minimize the negative impact and threats to the project or investment. And at the same time, the purpose of cash flow estimation is to maximize the impact of the project and opportunities. Estimating the free cash flows that are used in a capital budget analysis, it's appraising the riskiness of those projects. Now, I hope you learned. I hope I didn't go too fast, and I hope you understood what I was trying to say. Basically, cash flow is an indicator of the stability of the business. Thank you. God bless.